5 Wealth Secrets Most People Ignore, inspired by billionaires. There's a powerful shift that happens when someone truly understands money, not just how to earn it, but how it actually behaves over time. For most people, a bank account feels like safety. You open your banking app, you see a number, and that number gives you comfort. It looks stable, predictable, secure. As long as it doesn't go down, everything feels fine. But here's the truth. Money sitting still is not the same as money growing. A bank balance can stay the same for years and still lose value. Why? Because of inflation. Prices rise gradually. Food becomes more expensive. Rent increases. Education costs more. Travel costs more. Everything costs more. And while your bank balance might still show the same number, what that number can actually buy keeps shrinking. It doesn't happen dramatically overnight. It happens quietly, slowly, almost invisibly. If inflation averages just a few percent per year, over a decade, the real value of idle money can drop significantly. That means doing nothing with your money isn't neutral, it's a slow loss. This is where financially successful individuals think differently. They don't just focus on saving money. They focus on structuring money. Instead of keeping the majority of their wealth idle, they design systems. Systems that aim to preserve capital, generate growth, protect against inflation, build resilience during economic uncertainty. They understand that money has different roles. Some of it should be liquid and accessible. Some of it should be invested for long-term growth. Some of it should be protected from volatility. Each portion has a purpose. This video explores the framework many long-term investors use: a structured approach to wealth that balances safety with growth. It explains how capital can be positioned strategically instead of passively. And it breaks down the mindset shift that separates savers from builders. Because real financial security doesn't come from watching a number stay the same. It comes from understanding how money moves and making sure it moves in your favor. Gold, a historical store of value. Gold has held a unique position in human civilization for thousands of years. Long before modern banking systems, digital currencies, or even paper money, gold was recognized as a reliable medium of exchange and a symbol of wealth. From ancient empires to modern economies, it has consistently represented stability, durability, and trust. One of the primary reasons gold has maintained its importance is scarcity. Unlike paper currency, which can be printed in unlimited quantities by central banks, gold cannot be created at will. It must be mined from the earth through a costly and time-intensive process. The global supply increases only gradually each year, typically by a small percentage. This limited and predictable growth in supply helps protect gold from the kind of rapid devaluation that can affect fiat currencies. Throughout history, many currencies have weakened, been replaced, or disappeared entirely. Empires have risen and fallen. Monetary systems have been restructured. Inflation, hyperinflation, and financial crises have eroded the purchasing power of countless paper currencies. Yet gold has endured across centuries as a store of value. While its price fluctuates in the short term, its long-term ability to preserve purchasing power has given it a reputation as a financial constant in an uncertain world. For modern investors, gold is often viewed less as a tool for aggressive growth and more as a form of financial insurance. It does not generate cash flow like a business, nor does it pay interest like bonds. Instead, its strength lies in its independence from traditional financial systems. During periods of economic instability, geopolitical tension, high inflation, or currency weakness, gold has historically acted as a stabilizing asset. When confidence in financial markets declines, demand for gold often increases. This is why many long-term investors include gold as part of a diversified portfolio. Its role is not necessarily to outperform stocks or real estate over decades, but to provide balance. When other asset classes experience volatility, gold can help reduce overall portfolio risk. In this sense, it serves as an anchor preserving capital and offering resilience during uncertain times. There are multiple ways investors can gain exposure to gold. Some choose to hold physical gold in the form of coins or bars, valuing direct ownership and tangible security. Others prefer financial instruments, such as exchange-traded funds, exchange-traded fund, or gold-backed securities that track the price of gold without requiring physical storage. Each method has its own considerations related to liquidity, cost, storage, and accessibility. Ultimately, gold's primary function in many portfolios is preservation rather than speculation. While short-term traders may attempt to profit from price movements, long-term investors typically view gold as a strategic allocation designed to protect wealth across economic cycles. Its enduring history, limited supply, and global recognition continue to support its role as one of the most trusted stores of value in the world. Dividend-paying companies' ownership that produces income. One of the most important distinctions between saving and investing lies in the concept of ownership. Saving typically involves holding money in a bank account or a cash equivalent instrument where the principal remains static. Investing, by contrast, involves deploying capital into productive assets that have the potential to generate value over time. Among the most well-established examples of productive assets are dividend-paying companies. When an individual purchases shares of a company, they are not simply buying a ticker symbol or a fluctuating price on a screen. They are acquiring partial ownership in a real business. That business employs people, develops products or services, serves customers, and generates revenue. After covering operational costs and reinvesting in growth, some companies distribute a portion of their profits to shareholders in the form of dividends. Dividends are periodic payments, often quarterly, made to shareholders as a share of the company's earnings. These payments create recurring income streams that can supplement other sources of income or be reinvested to compound growth. Unlike speculative price appreciation, dividends represent tangible cash flow derived from actual business performance. Historically, many strong and established companies have used dividends as a method of rewarding long-term investors. Firms with durable business models, consistent profitability, and disciplined capital management often prioritize steady dividend payments. In some cases, companies develop long track records of not only paying dividends, but increasing them annually. This pattern reflects financial stability and management confidence in future earnings. Over time, dividend-paying investments can offer a dual benefit: capital appreciation and income generation. As a company grows, expanding operations, increasing revenue, improving margins, the market value of its shares may rise. Simultaneously, dividend payments may increase alongside profits. This combination allows investors to benefit from both asset growth and ongoing cash flow. Another powerful feature of dividends is reinvestment. When dividends are reinvested into additional shares, investors effectively purchase more ownership in the business. This increases future dividend payments and amplifies the effects of compounding. Over long time horizons, reinvested dividends can represent a substantial portion of total investment returns. Dividend-paying companies are often associated with mature industries such as consumer goods, healthcare, utilities, and financial services sectors where demand tends to be relatively stable. While no investment is without risk, established dividend-paying firms are frequently viewed as less volatile than high-growth speculative companies. For this reason, they are commonly included in portfolios focused on income generation, capital preservation, and long-term stability. This model represents active participation in productive enterprise rather than passive storage of idle currency. Instead of relying solely on the hope that purchasing power will remain intact, investors in dividend-paying companies align their capital with businesses that generate real economic output. They benefit from innovation, productivity, and market expansion. In essence, dividend investing transforms money from a static resource into a dynamic ownership stake. It reflects a shift from merely storing wealth to engaging with the mechanisms that create wealth, allowing investors to potentially build income, grow capital, and participate in long-term economic progress. Real estate, tangible asset with utility. Real estate has long been regarded as one of the most reliable and widely used tools for building and preserving wealth. Across different countries, cultures, and economic systems, property ownership has consistently played a central role in long-term financial strategy. Unlike financial assets that exist primarily on paper or screens, real estate is tangible. It is physical. It serves a direct and practical purpose. At its core, property provides utility. Residential real estate offers housing, a fundamental human need. Commercial properties provide office space, retail locations, and service centers. Industrial real estate supports logistics, manufacturing, and distribution. Regardless of economic cycles, people require places to live, businesses require places to operate, and goods require places to be stored and moved. This structural and ongoing demand gives real estate a foundational layer of relevance that is difficult to eliminate. One of the defining strengths of real estate as an investment is its ability to generate income. Rental properties, whether residential or commercial, can produce consistent cash flow. Tenants pay rent in exchange for the right to use the property, creating a recurring income stream for the owner. This income can help cover expenses such as maintenance, taxes, and financing costs, while potentially leaving surplus cash flow as profit. Over time, rental income may increase, especially in environments where population growth, urban development, or economic expansion drives demand higher. In addition to income generation, real estate often appreciates in value over the long term. While property prices can fluctuate due to interest rates, local market conditions, or broader economic cycles, well-located assets in growing areas have historically shown upward price trends over extended periods. Improvements to infrastructure, rising population density, and economic development can all contribute to higher property valuations. Another important characteristic of real estate is its relationship with inflation. As the general price level in an economy rises, construction costs, land values, and rental rates frequently adjust upward as well. This means property values and rental income often move in alignment with inflation over time. In contrast to cash, which can lose purchasing power when inflation rises, tangible assets, like property, may help preserve real value. This makes real estate an attractive component in portfolios designed for long-term resilience. However, direct property ownership is not the only way to gain exposure to real estate. Many investors participate indirectly through structured vehicles such as real estate investment trusts, REITs, or other pooled investment platforms. These structures allow individuals to invest in diversified property portfolios without managing tenants, maintenance, or daily operations. They provide liquidity and accessibility while maintaining exposure to real estate's income-generating and inflation-responsive characteristics. Ultimately, the key concept is that tangible assets often behave differently from cash. While money in a bank account remains static unless actively invested, real estate is inherently productive. It serves a function in the real economy. It generates income, responds to supply and demand, and can adjust alongside broader economic shifts. For long-term investors, real estate represents more than ownership of land or buildings. It represents participation in a fundamental economic need: shelter, workspace, and infrastructure, combined with the potential for income, appreciation, and inflation resilience. Personal skills, the highest return asset. There is one asset more powerful than gold, stocks, or property, and it does not appear on a brokerage statement or balance sheet: human capital. Human capital represents the total value of an individual's knowledge, expertise, experience, adaptability, and ability to create solutions. Unlike financial assets, which can fluctuate due to market cycles, human capital is internal. It travels with you. It cannot be confiscated by inflation, market crashes, or economic disruption. When developed intentionally, it often produces the highest long-term return of any asset class. Financial capital can generate income, but human capital determines how much financial capital you are capable of building in the first place. When individuals improve their skills, whether technical, analytical, creative, managerial, or entrepreneurial, they expand their earning capacity. A person who upgrades their expertise becomes more valuable in the marketplace. That value can translate into higher wages, better opportunities, expanded networks, or independent business creation. Income potential is rarely fixed. It is closely tied to capability. For example, someone who develops advanced digital skills, specialized professional certifications, communication mastery, or leadership competence often increases their economic leverage. They can negotiate better compensation, transition into higher value roles, or build enterprises that generate scalable revenue. In this way, skill development directly influences income trajectory. Markets fluctuate, asset prices rise and fall. Real estate cycles shift, stock valuations expand and contract. Even stable investments experience volatility. But the ability to create value, intellectually, creatively, or entrepreneurially, remains portable. It can be applied across industries, geographies, and economic conditions. Historically, individuals who continuously developed their capabilities were able to recover from financial setbacks faster than those who relied solely on stored wealth. Economic downturns may reduce asset values, but skilled professionals often adapt. They pivot industries, launch new ventures, acquire emerging competencies, or reposition themselves within changing markets. In economic terms, earning power frequently outweighs stored capital. A person with modest savings, but strong, adaptable skills may generate millions over a lifetime. Conversely, someone with significant stored wealth, but no productive ability, may struggle to rebuild if that wealth declines. Human capital also compounds, similar to financial investments. Skills build upon other skills. Knowledge enhances judgment. Experience sharpens decision-making. Over time, this compounding effect can dramatically increase both effectiveness and opportunity. Importantly, personal development is not limited to formal education. It includes continuous learning, practical experience, strategic thinking, emotional intelligence, and the ability to solve meaningful problems. In modern economies, problem-solving ability is one of the most valuable currencies. Ultimately, while gold preserves value, stocks generate ownership income, and real estate provides tangible utility. Personal skills create possibility. They are the engine behind wealth creation. They determine adaptability in uncertainty. And they represent the only asset class that directly increases both opportunity and resilience simultaneously. In a long-term wealth framework, financial assets matter, but human capital remains the foundation upon which all other assets are built. Alternative assets, diversification beyond the traditional as wealth grows. Investment strategy often becomes more nuanced. Many high-net-worth individuals choose to allocate a portion of their capital to alternative investments, assets that fall outside the traditional categories of publicly traded stocks, bonds, and cash. The objective is not speculation for its own sake, but diversification. By adding assets that behave differently from conventional markets, investors aim to build portfolios that are more resilient across changing economic conditions. Alternative assets represent a broad and diverse category. One segment includes private businesses. Instead of buying shares of publicly listed companies, investors may acquire ownership stakes in privately held enterprises. These investments can offer significant growth potential, particularly when the business operates in a niche market or demonstrates strong competitive advantages. However, private investments typically lack liquidity and require deeper due diligence. Venture investments represent another subset. These involve funding early-stage startups with high growth potential. Venture capital can generate substantial returns if a company scales successfully, but it also carries elevated risk. Many startups fail, and returns are often concentrated in a small number of high-performing ventures. As a result, venture investing is generally approached with careful portfolio allocation and long-time horizons. Commodities, such as energy resources, agricultural goods, or industrial materials, also fall into the alternative category. These assets often respond directly to supply and demand dynamics and inflationary pressures. Because commodity prices may move independently of equity markets, they can serve as a hedge during certain economic cycles. Digital assets have emerged as a modern addition to alternative portfolios. This category includes blockchain-based assets and related technologies. Digital assets can be highly volatile and are influenced by regulatory developments, technological adoption, and market sentiment. While they may offer growth opportunities, they require careful risk management due to price fluctuations and evolving regulatory frameworks. Collectibles, such as rare art, vintage automobiles, fine watches, or historical artifacts, represent a tangible and specialized alternative investment class. Their value is often driven by rarity, condition, provenance, and demand among collectors. Returns can be attractive, but valuation may be subjective, and liquidity can be limited. Infrastructure projects, including toll roads, renewable energy facilities, transportation systems, and utilities, are another form of alternative investment. These projects typically generate long-term, stable cash flows and may be partially insulated from traditional market volatility. They often appeal to investors seeking income and long-duration assets. While alternative investments can provide diversification benefits, they frequently carry higher volatility, complexity, and risk. They may involve longer holding periods, limited transparency, and reduced liquidity compared to publicly traded securities. For this reason, allocation size is typically aligned with an investor's overall financial stability and risk tolerance. The central principle is balance, not concentration. Alternative assets are rarely intended to replace core holdings, such as equities or income-producing investments. Instead, they complement them. By combining traditional and alternative assets, investors aim to reduce dependence on any single market driver. In a well-structured portfolio, alternatives serve as a strategic enhancement rather than a speculative gamble. When thoughtfully integrated, they can improve diversification, expand opportunity, and strengthen long-term resilience. Understanding the bigger picture to understand wealth building in the United States, or in any modern economy. It's important to step back and examine how the financial system actually works. At the center of that system are banks. When individuals deposit money into a bank account, those funds do not simply sit in a vault. Banks operate by lending a significant portion of deposited capital to borrowers, individuals purchasing homes, businesses expanding operations, consumers financing vehicles, or corporations funding growth. In return, borrowers pay interest. The bank earns the difference between the interest it charges borrowers and the interest it pays depositors. This is known as the interest spread. Savers receive a portion of the earnings, but the institution actively deploys the capital to generate returns elsewhere in the economy. This structure has existed for decades and is foundational to the U.S. financial system. It fuels economic expansion by circulating capital rather than allowing it to remain idle. However, there is an important dynamic at play: inflation. Inflation represents the gradual increase in prices across the economy. When inflation rises, each dollar purchases slightly less than it did before. Over time, this erosion compounds. Groceries, healthcare, housing, education, and energy costs all reflect these shifts. Now consider this in relation to deposit accounts. If inflation rises at 4% annually, but a savings account yields 1% interest, the real purchasing power of that cash declines by approximately 3% per year. The number in the account may increase slightly, but its ability to buy goods and services decreases. This is not a malfunction of the system. It is a structural feature of fiat currency, including the United States. Monetary policy, directed by institutions such as the Federal Reserve, plays a central role in influencing inflation and interest rates. When rates rise, borrowing becomes more expensive and savings yields may improve. When rates fall, liquidity increases, often stimulating economic activity. These cycles are part of the broader economic rhythm. For long-term investors, the objective is not to eliminate cash entirely. Cash serves an essential purpose. It provides liquidity, emergency stability, and flexibility during market volatility. Financial security requires accessible funds. The key distinction lies in avoiding excessive idle capital beyond reasonable liquidity needs. Many experienced investors seek to position surplus capital into assets that have historically demonstrated growth potential: equities, real estate, productive businesses, and other diversified holdings. Diversification plays a critical role in this approach. By spreading investments across different asset classes, industries, and economic drivers, investors reduce dependence on any single source of return. Historically, diversified portfolios have helped mitigate volatility while maintaining long-term growth potential. Understanding the bigger picture shifts perspective. A bank account is a tool, but it is not a complete strategy. Inflation, interest rates, and monetary policy are interconnected forces that influence real purchasing power over time. Financial awareness begins with recognizing these dynamics. From there, strategy becomes intentional, rather than passive, aligning capital not only with safety, but with sustainability and growth. A balanced allocation example, educational illustration, only to better understand how diversification works in practice. Imagine a thoughtfully structured portfolio built around multiple asset categories, each serving a specific purpose. For example, a small percentage might be allocated to gold. The goal here is not aggressive growth, but stability. Gold has historically acted as a hedge during periods of economic stress or currency weakness. In this context, it functions as a protective layer within the broader portfolio. A larger allocation may be directed toward productive companies' businesses that generate revenue, innovate, and distribute profits. Through ownership in established or growing enterprises, investors participate in economic expansion. Over time, these assets may provide both capital appreciation and dividend income, forming the primary growth engine of the portfolio. Exposure to real estate could represent another important component. Property offers tangible utility and, in many markets across the United States, has demonstrated long-term appreciation potential. Rental income can provide consistent cash flow, while property values may adjust alongside inflation. Equally important, though often overlooked, is continuous investment in personal skill development. Enhancing expertise, adaptability, and earning power strengthens financial resilience in ways no external asset can replicate. Human capital remains foundational to wealth creation. Finally, a limited allocation to alternative assets may offer additional diversification. Because alternatives often behave differently from traditional markets, they can add flexibility, though typically with higher risk. This type of framework seeks balance, protection, income, and growth working together. Again, this is strictly an educational illustration designed to explain diversification concepts, not financial advice. Emergency funds, short-term expenses, and daily transactions all depend on accessible capital. Liquidity creates stability, but assets are what drive growth. Inflation is a constant force within modern economies. Real estate develops. Innovation advances industries. Ownership in productive assets allows individuals to participate in that expansion rather than simply observe it. Historically, Long-term wealth accumulation has centered on ownership of companies. Financial literacy begins with understanding how money moves through systems, banks that lend capital, markets that price risk, properties that generate income, and enterprises that create goods and services. Participation is a personal decision shaped by goals, risk tolerance, and financial circumstances. If you found this perspective valuable, make sure to like, comment, and subscribe.